In this video, I'll be breaking down how much you need to make in order to afford a 2023 Chevrolet Corvette. I think you should really consider paying attention to one of these rules in order to avoid making a huge car buying mistake. I had a couple of friends that overextended themselves, thought they could afford it, ended up they couldn't, and now financially they're quite a few years behind where they should be. I've also got a link to a free auto insurance quote where you could save up to $600 a year, save yourself a little bit of money. It's the first link down there in the description, but more on that later. There are 4 options I'll be going over today, and some are dedicated towards more of the car and truck people, and then some are dedicated to those that don't really care and want to build their net worth as quick as they can. Stick around to the end of the video, find out which method would be best for you. Some people just want a reliable form of transportation. Some are willing to spend quite a lot more in order to get the car that they really want. So stick around to the end, find out what would be best for you. This is 4-Wheel Finance, a channel dedicated to helping you making smart car buying and financial decisions. Before I dive into that first rule, these videos take quite a lot of time and effort to make. Please give it a like, subscribe, comment down below what other vehicles you would like me to review. The first rule I'll be covering is the 24-10 rule. It's pretty popular, so you've probably heard of it before. This states that you must put at least 20% down on the vehicle. You can't finance it for more than 4 years or 48 months, and the payment shouldn't be more than 10% of your monthly gross income. Since the 2023 Chevy Corvette has an MSRP of $64,200, you would need to put down about $12,840. And with the average new vehicle interest rate of 3.86% and a 48-month term, this would bring your monthly payment to $1,156.45. Pay attention here that you're also paying about $4,000 in interest, and that would only go up if you have a longer term. Bankrate states that the average monthly insurance cost is $148, but this varies a ton depending on your age, your gender, your driving history, your car that you're insuring, what part of the country that you live in. So give a look at that smart financial link, see if you can save a little bit of money, or see how much it would cost for you to insure something like this. This would bring your monthly total to $1,304. Going back to that 24-10 rule, given your monthly cost is $1,300, you would need a monthly gross income of $13,044.50, which would add up to about $156,000 annually. I encourage you to take a look at the opportunity cost here. If you were to buy a cheaper $10,000 car, maybe even a $5,000 car if you can find one, and put what would be a car payment of $1,156.45 in the market instead, over the course of 5 years with just a conservative 6% rate of return, that would turn into $80,747.98, gaining over $11,000 in interest. Take a look at those M1 Finance and Acorns apps down in the description. It's very easy to get started. You can get started with just pennies, and I encourage you to do it as early as you possibly can. And this is just for the first 5 years. If you were to continue that for 10 years, it would amount to $188,000, which would be gaining over $50,000 in interest in 10 years. So that's quite a big jump there. You're almost gaining the interest on the actual price of the car itself. And this is just at a 6% rate of return, which is pretty conservative. The next rule is my own. And for my rule, I think you should have at least a 6-month emergency fund, invest 15% of your gross income into your 401k or 403b, and max out ideally your Roth IRA and your HSA, but I'll leave the HSA as optional. But I highly encourage you to take a look at that too, because that's a pretty good account. And I know it seems like quite a lot of saving and investing, but I don't give you a monthly percentage rule you have to stick to in terms of spending that money. So it's up to you to decide how you want to spend that additional monthly income. If you want to put it on a vehicle, or if you'd rather spend less and go out to eat more, go on more vacations and trips, that sort of thing. Or if you want to put it, new wheels, tires, roof rack. I'm not going to tell you how to spend that remaining money as long as you're saving and investing. And then the 6-month emergency fund just ensures that you're covered in the case of anything crazy happens, obviously like an emergency. And the investment portion gives you a little bit of financial security, especially later in life when you'll probably need it the most. The majority of people say, well, nothing's guaranteed. You should live your life how you want to now. And it's true to a degree that nothing's guaranteed, but it's difficult putting a value on having peace of mind for yourself or your family's future. The next rule is the Dave Ramsey rule. He's pretty popular, so you've probably heard of him before. And he thinks that you should have a 3 to 6 month emergency fund. The vehicle shouldn't be more than 50% of your gross annual income, and you should buy it in cash. Given the 2023 Chevy Corvette starts at that $64,200, you'd need a gross annual income of $128,400. And ideally, it's nice buying a vehicle in cash, as you would avoid having to pay $4,000 in interest in this case, and your insurance would be a bit lower. But obviously, not everyone has $65,000 in cash that they can put towards a car. And the last rule here that I'll be going over is called the 1/10 rule, which was developed by Financial Samurai. Personally, I think it's a pretty popular rule that the majority of people building their wealth should really pay attention to. It doesn't allow you to buy a new car because it states that you should not spend more than 10% of your gross annual income on a vehicle. So if you make $100,000, your car shouldn't be worth more than $10,000. So it's probably going to be used. It's almost guaranteed to be used. And you should own it for at least 5 years, but ideally more. And the theory here is to minimize a lot of your financial stress, frees up a little bit of money to invest in assets or opportunities that may come your way. It's a lot more stressful and difficult making those important life decisions, like whether you want to move, whether you want to take a new job, whether you want to have a new kid, etc., when you're worried about car payments each and every month. Once again, this is 4World Finance. I've created this channel just to really help people get an idea of what they're really spending on a car and what they could be earning in the market, making smart car buying decisions. I mean, I'm not against having fun or getting the car that you want. I just want to make sure that your bases are covered in terms of financing. If you've got any other questions regarding car buying or personal finance or how much of a car you can afford, please leave them in the comments down below, as well as other vehicles that you would like to see. And if you'd like to save a little bit of money on your car insurance, just take a look at that Smart Financial link. They'll shop around totally free, and it doesn't take anything to do it, so just go for that.